Hey folks, Metal Minds here. Today I'm fired up because gold just smashed through $4,000 an ounce in 2025. Yeah, you heard that right. A glittering beast that's up 54% year to date, leaving stocks in the dust and turning everyday investors into accidental tycoons. But here's the hook that should have you glued. While 99% of folks are still glued to their fiat funny money, watching inflation chew through their savings like termites on timber, the top 1%, the rebels who listen to whispers I started shouting years ago, are riding this golden wave straight to $5,000 by year's end, pocketing life-changing gains without breaking a sweat. I called this exact storm brewing back in 2020, when central banks were hoarding gold like dragons on a treasure hoard, the Fed was teasing rate cuts that'd make bonds blush, and geopolitical fires from Ukraine to the Middle East were lighting fuses under safe haven assets. It was the perfect storm, folks, a trifecta of chaos and cash flow that I predicted would rocket gold from sub-$2,000 doldrums to this euphoria, and now it's here, proving once again that ignoring the sheep bleeding it's too risky is how you build empires. See, the system's rigged to keep you skeptical, feeding you headlines about crypto moonshots or meme stock madness, while quietly sidelining the oldest wealth preserver in history, gold. The rebel's secret weapon against a world gone mad with money printing and endless wars. I know this trap all too well because I lived it. Back in the early 2010s, when inflation started spiking after the financial crisis hangover, everyone around me, mates, family, even so-called advisors, scoffed when I said I was diverting 10% of my scrappy startup cash into physical gold bars and coins. Mark, you're nuts, they'd say. Stick to property or pensions. Gold's for granddads. But I'd just grin and keep stacking, hiding those shiny bricks in a safe like contraband candy because I saw the writing on the wall. Central banks like China's and Russia's were on a buying binge, snapping up over 1,000 tons annually to ditch the dollar's dominance, while whispers of Fed rate cuts, those juicy slashes from 5% peaks down to 3% or lower, would flood markets with cheap money, driving investors to gold like moths to a flame. And don't get me started on the geopolitics. Escalating tensions in the South China Sea, proxy wars heating up, and election year saber rattling had folks worldwide clutching pearls and portfolios, funneling billions into bullion as the ultimate oh crap insurance. That 54% surge? It's no accident. It's the symphony of sovereign funds outbidding each other, pension giants reallocating amid rate cut euphoria, and everyday Joes finally waking up to gold's 2,500-year track record of outlasting empires. Billy, my old warehouse buddy from those lean days, laughed it off and blew his bonus on a depreciating SUV. Now he's staring at a retirement account that's barely budged while my gold stack ballooned from a modest $5,000 punt to over $200,000 today, funding my first yacht without a loan in sight. Phil, the sharp one, eavesdropped on my rants, dipped his toe in, and now he's golfing in Portugal off the dividends alone. The difference, rebels like us don't wait for permission. We act on the signals the system tries to drown out. And that's why I'm spilling the beans today with my Rebel Gold rule. The dead simple three-step playbook I used to turn naysayer sneers into seven-figure smirks, designed for you to snag your slice of this $4,000 party and surf it to $5,000 without the guesswork. This isn't Wall Street wizardry. It's street-smart strategy from a guy who bootstrapped from broke to baller. And if I can navigate this with zero inheritance, you can too. Let's break it down, step by battle-tested step. Step 1. Diversify 10% into a gold IRA, your unbreakable fortress against the fiat fiasco. Look, I've said it a million times, never put all your eggs in one basket, especially when that basket's woven from central bank IOUs that lose value faster than ice in hell during a heat wave. That's why rule numero uno is carving out exactly 10% of your investment portfolio, not your whole net worth, just the growth slice, and channeling it into a self-directed gold IRA, a tax-sheltered beast that lets you hold physical gold, silver, or even platinum without Uncle Sam or the taxman crashing the party early. I ignored the eggheads poo-pooing precious metals back in 2018, when inflation ticked up to 2.5%, and I rolled over $10,000 from an underperforming stock fund into my first gold IRA via a no-fee custodian like Augusta Precious Metals or Goldco. Easy as pie, folks. You start by opening an account online in 15 minutes flat. Pick a provider with IRS approval. Fund it via rollover or contribution, up to $7,000 annually if you're under 50, and instruct them to buy allocated gold bars stored in insured vaults. No paper promises, actual metal you own. Why 10%? It's the sweet spot, enough to hedge against that 54% YTD gold pop without overexposing if tech rebounds. Studies from Morningstar back this, showing diversified portfolios with 5-15% in gold/volatility by 20% during downturns. Fast forward to now. My IRA's gold allocation has compounded through the central bank frenzy, with the Fed's September 2024 rate trim to 4.75%, sparking a 10% single-month jump, and I'm sitting pretty as geopolitical jitters from Taiwan's Strait flare-ups push demand through the roof. But here's the rebel twist. Don't just buy and bury, monitor it quarterly, rebalancing if gold hits 15% of your total to lock gains. Billy skipped this, chasing crypto crashes. Phil followed suit, and his IRA's up 60% since inception, funding grandkid college without blinking. Your action item? Audit your 401k or IRA today. If it's all stocks and bonds, you're one recession from regret. Shift that 10% now, while gold's hot but not yet at my $5,000 call, and thank me when central banks drop another 500 tons in Q4 buys alone. Boom, fortress built, moving to step 2. Reinvest dividends from gold miners, turning picks and shovels into passive gold mines of your own. See, physical gold's great for the long haul, but to really ride this wave, you gotta layer in the upstream players, the mining companies whose stocks pay juicy dividends while leveraging gold's price surges for outsized pops. I learned this the gritty way during the 2020 COVID chaos, when lockdowns crushed everything but safe havens. While gold climbed 25%, miners like Newmont and Barrick exploded 50-100% as operational leverage kicked in. Higher gold prices mean fatter margins with fixed costs, pure rocket fuel. So rule 2, allocate half your 10% gold bucket, say 5% total portfolio, to a low-cost ETF of dividend-paying gold miners like GDX or GDXJ, and set it to auto-reinvest those 2-4% yields quarterly, compounding like a beast while you sip coffee. Back when I was scaling Model World, my hobby shop empire, I funneled $2,000 into miner shares during a dip, ignoring the bubble chatter. Those dividends reinvested through rate cut cycles and Ukraine gold rushes have snowballed into $50,000 plus, paying for family holidays without touching principal. How to, in 5 minutes, open a brokerage like Interactive Brokers or eToro, search for GDX, VanEck Gold Miners ETF, expense ratio under 0.5%. Buy shares equivalent to your 5% target and enable DREIP, Dividend Reinvestment Plan, so payouts buy more shares automatically. Why miners? That 54% gold surge translates to 80% plus for top producers per Bloomberg data, fueled by central banks' 100B plus annual buys and Fed cuts easing their debt loads. Geopolitical bonuses? Absolutely. Tensions in the Middle East have miners in stable jurisdictions like Canada and Australia churning record free cash flow, boosting dividends 15% YoY. Phil nailed this, reinvesting into Franco-Nevada royalties for steady 3% yields. Billy? YOLO'd into junior miners that tanked on scandals. The Rebel Edge. Harvest dividends tax efficiently in your IRA, and if gold hits $4,200 resistance soon, trim 20% of miners for cash to reload dips. I've done this thrice, netting 30% quick flips while the core compounds. This step's your multiplier, folks. Physical holds value, but miners multiply it, turning that perfect storm into your personal tsunami of returns. Finally, step 3. Sell partial holdings at resistance levels like $4,400 for quick profits, because even rebels know when to take the win and redeploy. Holding forever's for suckers. The system's endless FOMO keeps you hodling into oblivion, but smart money ladders out at technical ceilings, banking gains to fuel the next leg up. I mastered this during the 2011 gold peak at $1,900, selling 30% of my stack into strength despite to-the-moon hype. That cash-funded property deals that 10x'd while gold corrected 40%. Fast forward to 2025, with gold at $4,000, charts scream resistance at $4,400, a psychological barrier backed by 14-year highs and Fibonacci extensions from the $150 2015 bottom. My rule: Set alerts on TradingView for $4,300, then offload 25-50% of your position in tranches. Sell 25% at $4,400, another at $4,600 if it powers through, pocketing 10-15% profits to rotate into undervalued miners or even Bitcoin for diversification. I did exactly this last month, trimming IRA gold at $3,800 for a 20% gain since entry, reinvesting into GDX calls that doubled on the Fed's November cut signal. Why partial? Psychology and math. Full sells trigger regret if it runs to $5,000. My call, driven by 2T in emerging market gold demand and election volatility. But trimming locks conviction into cash, funding life upgrades without de-risking entirely. Billy held through 2011, got burned. Phil laddered like a pro, turning 10K into 40K by cycling profits. Your playbook. Use stop limits on your broker app to automate. If gold taps $4,400, sell 25% automatically, trail the rest with a 5% stop. This isn't gambling. It's disciplined rebellion against buy and pray mentalities, substantiated by JP Morgan forecasts pegging $4,800 by mid-2026 on sustained central bank flows. There you have it. The Rebel Gold rule in 3 unbreakable steps. Diversify 10% into IRAs for the anchor, reinvest minor dividends for the accelerator, and ladder sells at $4,400 for the cash out. The exact moves that turned my inflation-era hunch into a portfolio powerhouse, riding this 54% storm I foresaw when no one else dared. If you're still on the sidelines, ask yourself, why let the system trap you in regret when $5,000 gold beckons? Hit the comments with your first step, smash like if you're stacking today, and subscribe for more millionaire secrets. Your future self's already toasting you. Let's make 2025 your golden year.